Thanks for tuning in to Talking Point Unfiltered, and we'll try and have an unfiltered conversation with a really special guest. And my conversation with him before the show started makes me believe that I can have two different conversations with him, one on the art of money managing and two in the art of creating a business. Our guest today is Sunil Singhania. Sunil, thank you so much for joining in.
Thank you, Niraj.
Well, you technically matching the unfiltered description very well. I'm not, pardon me, but since I've come to your office, I came dressed accordingly. Sunil, very fluid global situation as things stand right now. But one thing that a lot of people are trying to think of, and I would love to know how you think of. So we start with the global macro first. It almost seems a dystopian idea that the developed nation is going to fight developing nations for low-skilled jobs. And that seems to be the narrative right now, per se. So when you think of all that's happened in the last 3 months, how do you crystallize relevant information and its implication on investing?
No, I think what has come across very clearly, I would say to a large extent was unexpected. To some extent, it was expected that Trump, even in his earlier first term, was talking about some tariffs, but this time it was like mass implementation of tariff, and I would say a little bit, very rude also to some extent, and I think that has sort of. Obviously China has got very pissed off, but maybe other countries are not being articulate, but no one likes the way it has been done. And to that extent, it came as a shock. However, as we dissect it, what you said clearly is logical. It's not going to be very easy. You talked about low-end jobs, which are what the developing world is good at because of the huge population and the low cost of labor. Now, technically, if you see if Nike were to shift 5 lakh of its workers, which are based in Vietnam, to US, you're not going to get that many people to sew shoes, right? And even if you get, at what cost? So 1 day wages is equal to 1 month's wages in other countries. And then even if you get them, the whole supply chain is still not established. So you need rubber soles, and you need leather, you need synthetic textile, you need shoelaces, needles, sewing machine, the glue, nothing is made in the US. So I think it is very clear. Maybe the intention is to make America great again from a 20-year perspective, but in the near term, it falls flat on its face, and it's very, very illogical. And I think to that extent, the US has already started to realize that. But obviously, ego and anger is more dominant than logic and calm. And I think in that respect, everyone is trying to find a face-saving solution to all this. And I think the markets are responding. Markets do believe that there will be some solution to it. I think Indian markets are already back to the pre-tariff level, so to say. And other markets will also respond, because when the world has moved to globalization last 2-3 decades, overnight it cannot move to deglobalization. We are all linked to everyone. And I think in that sense, obviously, it's tough because the volatility is huge, but at the same time, one has to take a logical call of what can happen from a maybe 1, 2, 3 years perspective rather than 1, 2 months perspective. I think 1, 2 months is going to be very disruptive, but things will calm down from a 1, 2, 3 years perspective.
So as an asset allocator, Sunil, are you taking a call that because the situation is so fluid right now, it might not be very material to talk about valuations and prices? Or are you taking that 3-year bet and putting money to work if the opportunity so arises?
So, Niraj, what is our job as portfolio manager? Our job is to try and find companies which will grow. At least our philosophy is invest in companies where there is visible profit growth from a 3-4 years perspective. So I think we continue to do that. Obviously, in the near term, some sectors, on the face of it, might look to be impacted positively or negatively. I'm saying on the face of it because you never know. There was a company who said our exports to US are only 3% of our sales, but their exports to Europe were 10-12%. And it is possible that those European companies, which are their customers, were in turn selling it to the US. Or if they're selling to Mexico, and Mexico is in turn selling to US. So I think it's very difficult to dissect everything. So I think we're just focusing on companies where maybe the potential or the possibility of they achieving their earnings growth over 3-4 years is more than some of the other companies. We are not doing too many exotic things because that would be playing blind. So I think we're just sticking to the portfolio, and at the margin, wherever we believe that one company or one set of companies can have more visible profit growth than the other, I think that is what we are focusing on. But one thing is very clear. I think China and US relations were never great. And after this, they have sold further. And therefore, from a 2-3 years perspective, very clearly, US companies will look at more outsourcing other than China. So this China plus one can in fact become China plus 11, in that sense, because their whole business can come to a standstill. So the likes of Apple and so many other companies will like to have a more diverse sourcing source than totally being dependent on China. And I think to that extent, opportunities over a period of time might open up.
But I mean, this has been spoken about, I mean, under different economic scenarios for a while. And the consistent throwback is that India has not quite taken the benefit of such a thing in the past. Could this time be different?
Yes and no. I think India could have done more. Yes. And as human beings, we always want things to be done more at a faster pace. And, so to that extent, we could have done more. But if you actually see, now we are net exporters of mobile phones rather than importers.
True.
A lot of import substitution has started. So whether it's electronics, which is very, very evident. So all the phones and refrigerators and air conditioners and so many other electronics which we consume are all now made in India. I think there's already a laptop policy in place. Tata has already done the groundbreaking for a semiconductor fab unit, and maybe others will follow. So I think there are a lot of things which have happened. But as I said, as human beings, we want more and at a faster pace. Maybe this will be the catalyst which will spur various governments, not only India, to try and make use of that opportunity to build ecosystem where they can basically get market share, which some of the countries like China or Vietnam might see.
Okay. Before we get into that nuance, Sunil, one or two more questions on the worldview that you may have, and it would. I mean, I realize the size of capital that you manage. I mean, there is significantly large opportunities that open up for you, but also that much higher responsibility because of liquidity, etc. But if a scenario comes out wherein the US were to enter maybe a bit of an inflationary period, if not a spiral, and other countries enter into a lower inflation number. Thankfully, our inflation numbers are also looking a lot more healthy. What happens to the incremental global flows? Part one of my question is, what's your 50,000 feet view? Part two of my question is, because you speak to a lot of large global investors who would be investing through your fund as well now, what is their view on India?
Sure. So I think India is in everyone's frame of mind. Obviously, it's not such a big allocation for them that they get too excited or too worried about it.
Okay.
But I'll give you a not so scary answer, and then maybe we'll touch upon the scary thing. So I think what was happening last 5-6 months was obviously US yields had started to come off, and currency was very strong. So global flows were going into US. Because you make money when yields go down on the upside as far as bond prices are concerned. Equity markets were doing very, very well because of huge liquidity, and were gaining in currency also. I think last month or so that has reversed. And that is very unlike what maybe Trump and his team would have envisaged. And I think that is something, maybe the most important reason why they are backing off a little bit now. So now what has happened is yields have shot up. 10-year yields are at 4.3, 4.4. 30-year yields are closer to 5%. DXY from 110 at its peak has fallen to 99. And now there's a reverse cycle. So those who are invested in US are now losing because bond prices have fallen 3-4%. Yeah. Nasdaq is down 12-14% year to date. And they're losing on currency also. If you look at US versus Swiss franc, or US versus euro, or US versus British pound, I think dollar is like really, really got butchered. And I think there is some reverse flow which has started to happen. But all said and done, I think US is still 60-65% of the world's market cap. I think that is a little scary, but at the same time, it's an opportunity. So, if you just wear the optimist hat, which we always are optimistic. So 25 years, we have always been optimistic. Even during COVID, we were optimistic. During war times, we are optimistic. And I think it's paid off well. So if 5% of the world's flow moves out, so, global flows, $20 trillion worth of equity is owned by global funds and 40 trillion by US funds and US investors. If totally 5% were to move out of US, because there it's, clear you can move anywhere, it's $3 trillion. And now if even now 5% of that 3 trillion comes to India, it's $150 billion. And, we get very worried when $20-30 billion moves out.
Yeah.
But this $150 billion can come into the country over the next 2, 3, 4 years. Even if 5% move out of US, and out of what moves out of US, only 5% comes. So technically 0.25%. And I think that is not far-fetched to envisage that money can come in. So I think there will definitely be opportunity. The other thing is, obviously, there are not too many assets and too many countries where you can invest in. And I think India to that extent stands out, because this is one country which can from 4 trillion go to maybe 8, 9 in the next 6, 7 years, and maybe to $20-25 trillion over the next 2, 3 decades. I think the problem in India has been slower corporate profit growth and valuations which are not entirely cheap.
Right.
I think both will get sorted with time. And I think that would be the time when flows come back, in a big way.
So you believe a time correction could be on the anvil, if not a price correction?
It's already there. So if you see, September is when we peaked, September 24. From there, index is down 12, 13, 14%, depending on, whether it's 22.5 or 23. You have already had 7, 8 months go by. I don't think anything dramatic is going to happen in the next couple of months, because there is still apprehension of what will happen after 90 days and so on and so forth. So you had 1 year of correction and 12-15% of price correction. The only problem is, normally in 1 year, your profit growth is 14-15%. So this correction of 15% technically is 30%. This time profit growth has been only 5%.
True.
So maybe it might last a couple of months more, but I think we are getting there. So our view is very clear. I think we have possibly hit the bottom of what we touched when tariffs were announced. But big money still has some time before we can get visibility of that to be made.
Okay. What is the scary answer?
So scary answer is something I don't know which will happen in the next 2, 3 years or next 20, 30 years.
Okay.
So US has $35 trillion of debt. Even at 4.5% interest rate, they have to provide $1.5 trillion in interest cost every year. Now, the only way problems can be solved, so this is the numerator. The problems can be solved if numerator reduces or denominator exceeds or increases. Numerator is not going to reduce because, this interest cost itself is so huge and the economy is not growing, so the denominator is not going to increase. So I don't know how this problem of this huge debt will get sorted. This Doge and reducing cost might help to the extent of maybe $300-400 billion. It's not going to be massive. But now with these tariffs coming in, I think we'll again have slowdown, job losses. It's not one-on-one that if you put tariff, you just multiply your imports by the tariff percentage and that is the income. I think that is what they're trying to presume. That doesn't happen, So I think, I don't know how that gets solved, this $35 trillion debt. How does that get solved? Frankly, that is something which is scary.
Okay. So Sunil, all through the number of years that, let's say, I've interviewed you, or maybe longer that you've managed money, right? We've lived in a regime of king dollar, US exceptionalism. Do you foresee the next 5 years of the current decade, or maybe 15 years of the next 2 decades, being a different regime? Is it possible to think of it?
So if you go back in history, always leaders will change.
Yes.
Some leaders will change in 10, 20 years, some will change in 100 years, some will change in 200 years, but leaders will always change. And I don't think anything is going to be different in this case.
Okay.
Now, whether dollar loses its relevance in the next 10, 20 years, low probability. It's not zero probability. Largely because there is no other alternative right now. And how much gold can you buy? So maybe, it will be there. But I think the trend of dollar continuously being very strong seems to be behind us. And all these actions are only, I would say, hastening the importance of dollar coming off.
Got it. Okay. Now, a bit of the local focus, Sunil, and because you straddle both the private and public markets with equal aplomb, a great sense of what's happening with the large companies, but also the mid-size or the small-size companies which are not be listed. Is economic activity a big issue right now, or do you reckon it's a cycle? Your view, and what is it that you glean from your portfolio companies when you talk to them?
So first the positives, and then I'll come to the challenges. So I think positives, India's macro is phenomenal. I think you mentioned about inflation, interest rates are coming off, fiscal deficit is more or less in control, tax collection is not 18-20%, but a good 12-14%, which is pretty good. Corporate balance sheets are phenomenal. Yes. You don't hear about stress, you don't hear about defaults. Bank balance sheets are pretty decent, except for some stress in microfinance or unsecured loan, which is a small portion. I think bank balance sheets are pristine and clear. We have had a new regime at RBI. 5 lakh crores has been infused back into the system. We already had 2 rate cuts. And I think the impact is already showing. It's normally a 60 to 90 days lag. Okay. So we're already seeing that. All the banks have cut their deposit rates. They're cutting their lending rates. I think it will help bring in more capex and more growth. But so far we have not seen it, but I think that is the positive. Challenge is corporate growth and corporate profitability for some reason has been very low. September we had 3-4% growth, December we had 5-6. March there are reports which talk again of low to single mid or around 5-6% growth in corporate profit. June was supposed to be the big quarter, but now I don't know how things will pan out because of some impact on tariff. We will not be that much impacted because we are not a big exporting country, but at the margin there will be some impact. So I think that has been the challenge. And I think when we meet companies, when we meet a lot of market people like textiles or something, a lot of other things, I think demand is something which needs to pick up. I don't know what would spur that. Rural demand has picked up a little bit. Urban demand is still a little bit, lagging behind, and that is reflected in all the numbers which are coming. Passenger vehicle 2% growth in number of vehicles sold, and so on and so forth. But I think we need that growth to come back. From a country perspective, oil falling is very positive. I think at $65, we will save an incremental, maybe $20 to $30 billion from what we envisage. Government is not going to pass on any benefit to the customers, and that means they will have that kind of revenue. So one is there was a little bit of overestimation in capital gains tax and STT in the budget. Maybe it will be used to bridge that. And second is if exporters need little bit of incentive because of some tariff. See, we should not forget that there's still 10% tariff. We just forgotten that because 26 के बाद 10 हो गया तो अब खुश हैं, but there's still 10% tariff. So I think there are exporters who will be a little bit stressed. So maybe the government will have to give that incentive. So I think right now we are balanced. We are good macros, but not so great growth as far as corporate profit is concerned.
But that's never a switch, right? It's a lever. What can dial up the lever? Would it necessarily be spending at the government's end? Because private capex, Sunil, just looking at the uncertainty, might not be forthcoming in the next couple of quarters.
So government capex obviously is a big trigger, which has started. Obviously because of elections and code of conduct and then multiple state elections, it got deferred a little bit. But now here it is started. And that is a big trigger because that's almost 11 lakh crores a year. Capex on the private sector is there. Only thing is the number of large groups who are planning to do major capex has reduced quite significantly in India. I think the animal spirit from entrepreneurs to some extent in capex heavy sectors has come off. There's been massive consolidation. So whether you look at steel or cement or so many other things, it's massively consolidated.
Yeah.
And therefore, we are dependent on 5 or 6 corporates, the Adani, the Ambani, the JSW, maybe some Birla, some Tata, and that's it. We don't have too many mid-sized corporates which were in existence earlier who are planning big capex. I think maybe interest rates coming off will be a big trigger, but most important trigger would be demand coming back. I think if cement demand goes back to 9-10%, you will have need for putting up cement capacity. If metal, demand goes up, maybe there is a need to put up that. I think right now, the demand is not strong enough for entrepreneurs to put up huge capacity.
Yeah, but we've been suffering that for a while. So therefore, just trying to understand. I know there are no clear answers, but will it need to be a government effort-led thing, or is it a natural economic cycle?
It's a combination of everything.
Of everything.
See, if there is government effort, then there will be demand.
Okay, fine. So,
if there is demand,
Okay, so therein
so
lies
if we spend like $150-200 billion on infrastructure, obviously there will be jobs and there will be cement and steel and metals and railways and so many other things, ancillaries and all which we'll need. And it's a sort of a multiplier effect, So I think this $150 billion, if you go back by the historic multiplier of 9 times, it is equivalent to almost 1 trillion plus effect on the economy.
Most certainly. The skeptic Sunil could argue, one argument that comes out is that if you strip the Nifty earnings estimates of 16% for FY26 by the exporter earnings entirely, because who knows what will happen, then the earnings growth might be about 10-11% for FY26. At that growth, on the back of just a 3-4% growth for FY25, why should the Nifty even trade at historical average multiples of 18 times? Why it could even trade at 17 or 16 times? What would you say to that? And therefore,
if you keep on stripping this and stripping that out, then I can also argue that you strip the Zomato and Hindustan Lever and Asian Paint and Nestle and all those companies out from Nifty, you will be at 10p. So, this slice and dice does not work, The second thing I mentioned that yes, we have reacted, but we are not exactly very cheap. And that's the reason why big money is not flowing in.
Right.
So, if we start to get that view that this estimate of 15% can happen, then you will have a good flow. And, it's very difficult to take a call on the next quarter earnings. How do you take a call on March 26 earnings? Uske pehle, I don't know how many Trumps and how many Putins and how many other leaders in the world will have so many comments to make. It's not like a very stable kind of a global environment.
A clutch of sectors that have been employment generators and great revenue companies. IT, for example, right, fits the bill completely. Multiple cycles, multiple times doomsday scenario written, and have overcome and thrived. Is this time different?
So IT has, as you rightly said, they have been survivors. And, despite all headwinds which came in, I think IT companies kept on growing. I think the growth rates surely will come off for multiple reasons. One is obviously AI will have some impact. It will not have a dramatically negative impact, but it will also not have no effect. There will be some effect. Second is this whole GCC, which is the Global Capability Centers which are being set up in India. I think all major clients of IT services companies, of Indian IT services companies, are setting up their own GCCs. I read in the newspaper that Walmart from one center is now looking at setting up another center. So actually, services exports have been 13-14% growth.
Right.
But listed companies have seen only 5-6% growth because the GCCs are growing faster than the listed companies. So I think this growth rate of 14-15% for IT companies will fall to maybe 6-7%. But even at 6-7%, the profit growth may be to the extent of 8-10%. The only thing is the tailwind of dollar appreciating and rupee depreciating might not be there to the same extent. However, the cash conversion for these companies is huge, and they end up distributing, almost 5% of the market cap in terms of dividend or buyback.
Yeah.
So, if you grow 7-8% and 5% is the dividend yield, you end up making 11-12% for a very, very stable sector.
True.
But I don't see multiple re-rating from here.
for large or mid or small, whatever it is.
See,
Because
stock specifics,
Haan,
one company ends up growing faster than the other, then it's a
That's
different
separate.
thing. I'm just taking sector as a whole.
right.
It's very, very tough for them to have a multiple re-rating from here on.
Got it. Okay.
And if US suffers, in fact, at the margin, they might see pressure and they might not grow at all.
Got it. Okay. Sunil, from whatever little I understand of your style, and correct me if I'm wrong, but you bank a lot on numbers, right? I mean, the narrative is one, but it should show in the numbers.
Expected numbers.
Expected numbers. But I don't think you're a BAP investor, right? Buy at any price. शायद आप वो philosophy नहीं है. So यहाँ पे, when the markets have corrected the way they have, with reason of course, but valuation is not very cheap. Is it becoming a very, very bottom-up market? But also, connected to that question, for the size that you have, doing just relying bottom-up investing might also become very difficult, right? So how do you kind of think about it? What themes appeal, and how do you go about investing currently?
So one is, Niraj, we have different types of funds. So we do have exposure to larger companies also.
Of course,
reasonable
yeah.
exposure. So it's not that all our stocks are smaller.
No, I didn't mean that. Sorry.
Second is, I think it's challenging. I would say the time is challenging because what you envisage as the likely growth is not coming for the last 2-3 quarters.
Right.
And as I said again, June is again become a question mark because of external thing. Otherwise, June was looking good. So I would say, it's not that there are not great stocks available. The only problem is that your assessment, your expectation of earnings, that confidence has pushed back by another quarter.
Got it. At least.
At least. Now in that period, I don't know what external events might come in. So I think what has been a problem last 3-4 months for investors has not been that the market has been, soft or flat. It's been the huge volatility. One day stock is up 10%, the other day the stock is down 10%. How do you react to it? And how do you, I don't know how, but how do you create your portfolio where obviously, you're creating a long-term portfolio, but you have to survive in the near term also.
Thank you so much, Sunil Singhania, the investor, the fund manager, and the businessman.
Thanks a lot for having me. Best wishes to you and all your viewers.
Yeah, and to you and your team, Sunil. Fantastic business setup. All the best. And viewers, thanks for tuning in.